Hello and good morning. It is currently 9 o'clock on the 25th of February, and my name is Jonathan Greenstein, and welcome to today's joint Complyport HFW webinar, Regulation in the Insurance Industry, Looking Ahead at 2021. I am joined by three leading experts in this field, Kostas Frangiskidis and Will Reddy, Partner and Senior Associate, respectively at HFW, and Paul Granger, CEO at Complyport. Kostas is an insurance and reinsurance specialist. He has over 26 years experience in advising on contentious insurance and reinsurance matters, including Lloyd's and other regulatory and disciplinary proceedings. He's led a number of high-profile cases before the courts and in arbitration in many cross-border reinsurance disputes. He's an active member of professional reinsurance institutions such as Arias UK, BILA, and ERLA. Will Reddy is a senior associate in HFW's insurance and reinsurance sector group. He advises clients in the insurance sector on a range of regulatory and compliance matters and has nearly 10 years experience in the sector. He's also spent time, He has always spent time on secondment to the Prudential Regulation Authority. Paul is CEO of Complyport. He brings with him over 35 years of financial services experience, including over 30 years in the financial services regulatory and compliance consultancy and in wholesale and reason. He is chairman of the Financial Planning Standards Board for the UK, chairman of the International Governance and Compliance Association, and a former director and steering council member of the Association of Professional Compliance Consultants. Before we begin, I would like to cover some brief housekeeping points. Either at the top or bottom of your screen, depending on how you have it configured, you'll see a button called Q&A. If you have any questions, please ask them there and we'll try and get them through them as quickly as possible at the end of the session. Please do not post questions into the chat function as this will not be moderated. I'd like to invite Paul to start today's talk by looking back at 2020 and the key issues firms had, and in some cases still have to overcome. Paul, I think you might be on mute.
Apologies, Johnny. Thank you. Good morning, everybody, and thank you for attending today to hear what we have to say. I'm just going to, in this quick session, give an overview of, the year that was 2020, and as Johnny indicated, the overhang that we will have to deal with in 2021 and beyond. Clearly, the major event by a long stretch for 2020 was the emergence in late, 2019, of COVID-19, the novel coronavirus, and its impact. The UK gradually saw cases crystallise. We realised what we were dealing with. There was a sense of disbelief in some ways. Lots of reference back to the so-called Spanish flu of the late post-World War I period in the early 1920s. And we went into lockdown around about the third week of March. And we seem, to a greater or lesser degree, to have been in a stage of lockdown ever since. Sometimes the rules have been relaxed, sometimes they've been tightened up, but effectively, a bit like a concertina, the framework has flexed, sometimes been more restrictive, but nevertheless has been in place, as I said, for now virtually 12 months. And that's had a massive impact on everybody's life, but particularly from a working life in the service sector. Focusing specifically on the insurance sector, in general, the kind of services that are provided tend to be office-based. They tend to involve the concentration of large numbers of people, and particularly the concentration of senior management. So in terms of a perfect storm and in terms of disaster recovery and business continuity, I would say the insurance sector has had to start to address some of the issues it would expect clients to address, and policyholders to address. And I know later this morning we will look at the Supreme Court test case, which again began to crystallize some of the issues that, let's say, might have been framed in terms of, put your own house in order first before lecturing others. So there was clearly one sort of framework for the sector as a whole. The second, more particularly, is perhaps more generic, and that is the question of remote working. So it's particular to every firm involved, but there are some relatively generic issues there, particularly around business risk, things like cyber risk, the threats to cyber security, data security, approved working practices being carried out and enforced, compliance, monitoring what people were actually doing in a way that didn't breach civil liberties, but was robust enough to provide some comfort to firms and to regulators that business was being conducted properly. And against that kind of environment, then there were questions about whether staff needed to be furloughed, whether jobs became possibly even redundant, and whether there was actually any merit, the sort of the silver lining in the cloud from working remotely. Did it provide sufficient efficiencies? Did it begin to question the logic of operating in a highly concentrated fashion where there were high people dependencies and high dependencies on physical location? Certainly I have experience of a number of firms who've said, actually, we are far more efficient working remotely and never intend to go back to the previous business model. There are other firms who clearly feel that actually the old business model is what suits them best. So we've seen conflicting messages from different firms that we work with, and it's going to be one of those things, I think, that maybe there is no one size fits all answer. Alongside that, we've had issues around the fact that the UK economy has probably been hit the hardest of all the developed economies. GDP down to virtually 10%, a recessionary figure, twice that of the United States and most other European competitor countries. So clearly that's going to have a pretty big impact. What will be the response to government? We won't know till we hear what Rishi Sunak proposes. Will it be big picture? Will he go in for something fairly revolutionary along the lines of what Alistair Darling did back in 2008, effectively nationalising large chunks of bad bank debt? Or will it be something lesser? I have no firm view one way or the other. We'll wait to hear what the proposal is, but certainly those recessionary pressures are not going to go away. We will have to live with them and trade through them. We can only hope in many ways that we get a bounce back that is fairly rapid, and perhaps much more rapid than any other. There hasn't been a recession of this depth actually for about 400 years. So it will actually be very interesting to see how fast we do bounce back from it. And I think getting back to parity will be a significant milestone, never mind getting back into growth. Then, of course, there was the Brexit transition period end. We arrived at the 31st of December 2020, despite the best part of 3.5 years of warnings about the fact that there was not going to be any palatable trade deal, simply because there wasn't the legislative authority within a number of directives to grant that. So a straightforward and simple replacement to what had been the single European financial market was never going to happen. Nevertheless, we certainly have arrived at the 1st of January this year with a number of firms, to say the least, mildly surprised that the passporting system had ended, and that there were now serious constraints on the way that they could conduct business. I have to say this is mainly in the insurance distribution sector. But it seems to be slightly worse for UK firms trading out of the UK into Europe than our experience of dealing with European firms seeking to come into the UK. I'm sure that that is to a large degree influenced by the fact that the UK has granted more or less blanket equivalence across all the areas in the single financial services market where it could. And has initiated the temporary permission regime for those firms that were trading under distribution passports or similar. Nevertheless, that there is a quite sort of crystallized issue that's not yet resolved with regard to brokers, for example, having access to parts of the Lloyd's market from Europe. And some of the constraints on them where they deal with both continental European or EU EEA based risks, as well as risks based outside of the UK. And I'm certainly aware that there is a continuing dialogue in regulatory terms about how best to resolve some of those legacy issues. In addition, we also had the US election, and that was a bit of a game changer too. Donald Trump and the sort of hardline Republican agenda was replaced by Joe Biden and a more Eurocentric Democratic administration. Clearly, there is a lessening of the dislike for the EU that was experienced under the Republican administration and particularly from Trump himself. The mandate from the Democratic administration is much more along collaborative and cooperative lines. Now that's good news for the EU. It's perhaps slightly less good news from a UK perspective if the UK government is intent on increasing divergence away from the EU. So that poses a challenge, I think, for the next number of years, certainly up to the next election and maybe beyond. And of course, we have a UK election due in the next number of years and a further US election shortly after. So there will be some interesting developments there. Traditionally, the UK and the US have had, or I should say the EU and the US to date have had fairly good equivalence relationships, but these have only ever really touched upon what I would call macro market issues or wholesale market issues, and don't really affect the ability to conduct business in the state. You know, that is still the preserve of the local domestic regulatory authorities. So again, an interesting agenda item to keep on what I would call the horizon monitoring radar, and be mindful of developments as they arise. I think the biggest impact there is likely to be any prospective trade deal between the UK and the US, but I understand that that's not imminent, and to the best of my knowledge, I'm not sure serious discussions have actually yet opened on that at all. And the final point I'll just flag is the increasing awareness and predominance now of what used to be known broadly as green or environmental issues, but which have now become firmly fused into issues relating to governance, risk and compliance and social responsibility, and are now widely known as ESG or environmental, social and governance issues. The UK has adopted quite an aggressive stance towards the whole issue of climate change and greening the economy. There are now ESG metrics, ESG taxonomies and ESG reporting requirements that will have to be met by listed companies and funds. That is bound to influence corporate behavior, and that will percolate down from the listed firms and large enterprises to SMEs and even to a degree micro enterprises, I'm sure. The public, the customer base, if you like, is now becoming increasingly ESG aware. It was quite remarkable how many people commented during the more strict parts of lockdown last year on how much more pleasant the environment was with less traffic, less aircraft noise and so on and so forth. And I think it's also noteworthy that you know, for quite a considerable period now, I think the period concerned is getting on for a significant number of months, but the UK has been providing electric power from domestic production capacity without needing to burn coal to do so. So these are important milestone developments. And of course, the UK is hosting the climate conference in November. And this is being given a considerable push by the current government. There appears to be quite strong cross-party consensus in the UK on this issue. So I don't see ESG issues going away, and I don't really see the UK diverging to any significant degree from the EU on this question. This is a fundamental part of the, or a fundamental issue arising from the whole climate change and climate crisis spectrum. So I don't see any hope there of any divergence arising to any significant degree at all. And that brings me then to, well, what does the post-COVID, or the, let me call it, the return to work environment look like? Because I'm not sure that COVID will ever actually go away. I think like flu, it will be, or like the common cold for that matter, which is also a coronavirus. I think it's one of those conditions that will affect humanity for a considerable period of time going forward. I think also that what we'll learn to do is to manage that risk in much the same way that we now do with a number of other diseases that used to be largely debilitating or fatal. As a result, we'll just have to adapt the way that we go about our daily lives. The government this week announced an outline timetable. I'm not going to call it any more than that at this stage, because according to the government, it is data-driven rather than calendar-driven. However, having analysed the outputs from Monday, I think the remarkable thing is that there are many, many, many references to dates in there, but very few, if any, references to data metrics in terms of, well, what are the hard indicators that will allow an opening or the timetable that is laid out as a draft timetable to actually be implemented. So I think it remains to be seen whether the government is serious about being driven by the data, or whether indeed the calendar dates will by default end up driving things. But that then raises quite a number of issues in terms of return to work planning, not the least of which is the whole question of vaccinations. Schools return on the 8th of March. Past experience of mass return to education is not good. In all instances, this has produced at least a temporary spike in the R rate, as clearly numbers of people who are prospective carriers, asymptomatic, return to a classroom environment where, even with social distancing and other hygiene measures, there is the risk of a spread of infection. It's not so much the children that are the problem, although that can be an issue in its own right. Children are not immune from COVID. They just don't get terribly sick, according to the statistics. However, it is an issue where a teacher or other school employee has come into contact with somebody who is either infected or is required to self-isolate, and under those circumstances that can have a ripple effect. Clearly, if there's no teacher, children can't be in school. That has a knock-on effect for parents. So I think the whole issue of vaccinations and is going to have a, let's say, not necessarily a predictable impact on the return to work, but it will have an impact, and it might make the return to work a little bit staccato, and might make the return to work one of those issues that doesn't go as smoothly as the government has indicated it probably could do. The other issue, though, relating to vaccinations is really one of what's the policy then of first and foremost employers in general, but then particularly what impact does that have for policyholders and others who may then start to set requirements with regard to, we want evidence that you've either had a recent test or had a vaccine, what does the implication does that have for things like, say, travel insurance, business interruption insurance, and so on and so forth? So an issue that's yet to be resolved. There's no clear guidance from government or from any other authority on the question of vaccinations, other than to say there are human rights, there are medical confidentiality issues, and you know, the industry in general will have to work out what those implications are for itself. There are implications arising as well in terms of the pace of return to work. There are clearly major health and safety implications for employers. In the return to work environment, you know, first and foremost, will all staff be required to return to a workplace? Will staff be required to work remotely, or will there be a probable compromise between the two, depending on job need, but also some personal preferences? There's certainly evidence of a very high anxiety or fear factor amongst many employees about returning to workplace. But equally, there are some employees who are tearing their hair out and, you know, would quite welcome a break from working around the kitchen table, homeschooling, and all the other distractions of being away from the workplace. Traveling to and from work is also going to be an issue. The travel, the infrastructure in the UK, certainly outside of London, is not really geared up to mass transit, with the exception of the road network. But this does raise issues again around the ease with which people will be able to travel to work, issues around staggering arrival and departure, perhaps. It also raises questions around travel whilst at work, travel to meetings, from meetings, travel on business. Certainly overseas business trips look like they're off the agenda until, you know, probably the late spring at the earliest. There are also other questions. You know, the PPE and hygiene issue has not gone away. In offices, is it prudent now for employees to wear masks? That's not necessarily very conducive to good communication across an office or within an office. And there are also other sort of health and safety aspects as well, in terms of office versus home working, around things like, for example, not just physical health, but also mental health that will need to be taken into account. And finally, the sheer sort of logistics of what risks then arise in terms of working from home versus working in the workplace, and what implications does that have, and particularly in terms of risks to be dealt with and insured. So having raised those questions, I will now hand over and be very happy to take questions later. Thank you.
Thank you, Paul. We'll now pass to Kostas, who'll talk about the Fca test case.
Yes, thank you, and hello everyone. So you may think this is a random slide. It's a slide of a bus, a red bus, obviously a route master. And I'd just like you to think about that travelling to the cliffs of Dover. And that is obviously a restaurant. I think a lot of us have forgotten what that looks like or feels like. I'd ask you to think about a restaurant and also a restaurant with a takeaway attached. It'll all become clearer as I go through a summary of the recent FCA test case that went to the Supreme Court recently as regards whether SMEs could recover business interruption losses from certain non-damage extensions. I should also start with a disclaimer. These are my personal views and not the views of my firm. So in January, the Supreme Court handed down its final judgment in the test case brought by the FCA on the response of business interruption policies to COVID-19 losses. Importantly, this didn't deal with individual claims. Agreed facts were agreed between the FCA and a number of insurers who had agreed to participate in this test case. So this test case was effectively a test case brought by the FCA on behalf of SMEs, small and medium-sized enterprises, who had bought limited BI cover, usually for low limits, usually in the region of £100,000. But so far, insurers had declined to pay, and a number had agreed, as I said, to join the test case to allow the courts to interpret the relevant clauses. Obviously, this was in the interests of the public, of policyholders, and so insurers were sensible to join this action. Now, it's important here, as an overarching comment at the beginning, is that the courts, when looking at this, looked at it on the basis of we're dealing with ordinary policyholders. We're not dealing with sophisticated insurers, or as they put, pedantic lawyers. So the lawyers get a bit of a bashing in the court's decision, so you'll be happy to hear that. The court's overarching objective, it says, was to establish the legal effect of the insurance contract as it applied to the facts in circumstances where you have an SME or an ordinary policyholder. Now, an example they gave is, well, you've got an SME, you've got a policyholder, he's not an insurance expert. It may be a 93-page document, insurance policy. He may get to page 23 or even get to page 93, but he can't be expected to consider the nuances of the clause at page 23. So that's the way the courts approached it. Now, in this summary, and I'm going to try and be as succinct as possible, but I've given these talks for an hour or more on a lot of the intricacies, but I will try and do it as quickly as possible because I think I've got 10 to 15 minutes. But I will give you the headline points to take away, which are important. Now, the court considered 3 types of non-damage extensions. These are non-damage extensions. Jonathan, could you just put the clauses up on the screen, please? Thank you. I won't go through the clauses in detail. Those are the clauses. Thank you, the wordings. As we don't have time, but I will deal with them specifically and provide my comments specifically, albeit not by reference to each word of the wordings. So these are non-damage extensions. Now, this is important because the courts did not look at what are called, did not look at property damage leading to business interruption losses. Non-damage extensions, as they are defined, do not require property damage for you to claim business interruptions. The courts didn't deal with where you have property damage cover leading to business interruption, because it's generally accepted that the COVID virus, generally accepted is quite broad, but generally accepted by the courts maybe, that the COVID virus is unlikely to be construed as causing property damage. So we're only looking at non-damage business interruption extensions. So in general, the court found in favour of the SMEs. It broadened the scope of cover that the lower divisional court had found, and therefore extended the liability of the insurers. Now, let's turn to notifiable disease extensions. These are usually triggered by business interruption loss caused by either the presence of notifiable disease within, say, 25 miles of a particular premises, or in the vicinity of insured premises. So the BI loss is caused by the presence of a disease within a radius, here say 25 miles, or within the vicinity of insured premises. This is what was called the disease clauses. Prevention of access clauses, on the other hand, do not include any sort of disease element. They respond to an action of a competent authority denying or hindering access to the insured premises due to an emergency or danger within a specified number of miles or in the vicinity of those premises. So it's all to do with a competent authority's mandates, orders, hindering the access to the insured premises due to an emergency. And that's within, again, a particular vicinity, but no disease element. Hybrid clauses are a mix of the disease clauses and the prevention of access clauses, in that they respond to authority action consequent upon the occurrence of a notifiable disease. So those are the 3 types of non-damage extensions that the courts examined, the Supreme Court, and it's the final decision of the Supreme Court on these issues. If I start with the disease clauses, the notifiable disease clauses, the Supreme Court found that the reference in these clauses to the occurrence of a disease refer to something happening at a particular time, at a particular place, in a particular way. Now, this is important because in each case of COVID under the disease clauses, it was held to be a separate occurrence or event when you construe that clause. And that's different to the general outbreak of the disease across the country, which is not an occurrence or an event, but rather a broader state of affairs or what is technically called as an originating cause, which is another issue that comes into reinsurance and aggregation, but that's for later or another time. So when you construe the disease clause, it's construed narrowly. An occurrence is an event. So here it's the event is one case of COVID-19 within the vicinity, within the 25-mile radius. So that's the definition of the peril insured, and that's favourable to insurers. It's a very narrow definition, it's a narrow risk that's defined, and it only responds to occurrences of disease in the insured area. A similar approach was taken by the court to the construction of these elements. Now, you may think at this point, if you've read the judgment, that the insurers have won. Well, no, that's not the case. So the Supreme Court, having construed the disease clauses narrowly, then turned to causation. So in insurance law, of course, you have a peril that's insured, a risk that is insured, but you must then look to see, has that peril that's insured caused the loss? And the test here is the proximate cause test, the real or efficient cause of the loss. So whereas insurers may have succeeded on construing the peril, the definition of the peril insured, when we get to causation, things drastically change. This is because usually you have what's called a but-for test when trying to decide what is the proximate cause of the loss. What is the proximate cause leading to a business interruption loss? You use the but-for test, i.e. but for the happening of the peril insured against, the policyholder wouldn't have suffered any business interruption losses. So in the case of the disease clause, you have an event of COVID within a specified radius or within the vicinity of the premises. So if you apply the but-for test, effectively the policyholder will receive no cover, because it's impossible to prove for that one incident of COVID in that area that the policyholder would not have suffered BI losses. So the courts looked at it and said, well, that's got to be the wrong test. We've got millions of cases of COVID here, multiple independent causes of loss throughout the country. So does the but-for test apply? So what happened was the Supreme Court looked at another principle of concurrent causes. And here that general principle is where you have two proximate causes in the sense that the loss would not have happened without one of the causes being present. So here an example is where a ship sinks because of adverse weather and because the hull was badly designed. You need both of those. They're both proximate causes, they're concurrent causes, and you need both to obtain, and both are approximate causes. You can't have one without the other. But one is covered and one is not covered. So if one, for example, the adverse weather event is covered, but the badly designed hull is uninsured, you have cover. If the badly designed hull, for example, is excluded, you don't have cover. So that's a general principle of concurrent causes. But here the court said, you've got to look at this differently. You've got multiple independent causes across the country. So many hundreds of thousands of occurrences of COVID. So the but-for test could not apply here, they said. It was impossible to say, but for all these instances of COVID across the country, loss wouldn't have been suffered by a policyholder. And the best example for this is the bus. Now, I describe it as the red route master travelling to the cliffs of Dover. The court gave a much more succinct example. It's a bus. It goes to a cliff and it's being pushed off a cliff by 12 people acting together. So as with COVID, no one person could be said to be the but-for cause of the bus falling off the cliff. You cannot say, it cannot be said that but for person number 11 of the 12, the bus wouldn't have gone over the cliff. So it would be unfair to apply the but-for test because it would result in the damage to the bus having been caused by no one. So the court therefore said we have to look at this in a different way. Cover was provided because of at least one case of COVID within an area covered by the clause. And the point here is because each individual case of COVID was a separate and equally effective cause of the government restriction. So each individual case of COVID across the UK was a separate and equally effective cause of the government restriction. So here they've extended, broadened the law of causation to effectively find for policyholders where the definition of a peril insured is actually quite narrow. So that's the main issue, the main way in which the courts found for the policyholders. They construed causation in a novel way, perhaps is a way to describe it. I personally don't think it's changed the default standard, which is proximate cause and the but-for test. But for here, you could see how this was working. Another example they gave was also where you have a hunter, two hunters going out to kill some deer, and accidentally they kill a poor passerby, a hiker. But you can't tell which of the hunter's bullets killed the hiker. It could have been either. So you can't say but for one of the hunters, there wouldn't have been a loss. So that's a good example of what the courts were looking at here. Another important issue was what's called the Orient Express Hotels case. It's a very leading case on wide area damage. Now, this decision concerned a hotel in New Orleans, damaged by Hurricane Katrina. Here it was held that, but for the property damage, so the hotel was damaged, but for the property damage, the hotel would still have been affected by the lack of tourism in the city as a whole. And so the loss should be adjusted to account for this. So here what you're doing is you're looking at what the courts describe as the counterfactual, not what happened in reality, but look at the counterfactual, which is there was no damage to the property. If there had been no damage to this hotel, it still wouldn't have received any tourists because of the wider area damage. So when comparing it to this scenario, the Supreme Court actually said this isn't right. This can't be right. And it held that where you've got an insured peril and an uninsured peril arising from the same underlying fortuity, here it's the hurricane or COVID-19, the losses resulting from both operating are covered. So this particular case, a very leading case, was overturned by the Supreme Court. I'm sorry if I'm going through this very quickly, but I'm conscious of time and I want to give the others the opportunity to go through the interesting regulatory issues. There are some other issues. Jonathan, if you can go to the next slide or the previous slide, I can't remember. Go to the next slide, sorry. Keep going, that's that. Back one, that's it, stop. Okay. Okay, well, there's one issue, actually, it's not on this slide, but it doesn't matter. It's trends clauses, which are very important. And the Supreme Court dealt with these as well. Now, trends clauses, as I'm sure many of you know, are just claims to account for trends and circumstances which would have affected the business in any event, i.e., but for the insured peril. Now, the Supreme Court, the way they described this, and this goes to the quantification of loss, not to causation, not to how you define the peril insured, but how do you actually quantify the loss once you've got through the other two stages? And what the court said was that these are the part of the machinery to quantify the losses. But the Supreme Court said that such clauses only permit adjustment for trends and circumstances wholly unrelated to the insured peril. So if we look at an example of a restaurant who has a star chef, he hands in his notice just before COVID. Here, under the trends clause, the insurers of that restaurant could adjust its loss to account for the loss of business that would have arisen out of the chef quitting. However, they could not adjust the loss due to a downturn in business in the weeks leading up to the restaurant's formal closure as a consequence of people's fear of socializing due to COVID. So that's an important point here. Now, one other point actually I wanted to raise in relation to prevention of access clauses that's where there is no disease element required. I think it's important here. I mentioned that the causation aspects generally relate to the construction, to the application of all three clauses. But the one point on prevention of access is important to take on board, is that in the lower courts, they found for there to be a prevention of access to the premises, there had to be a complete prevention of access to the business. So this is where the restaurant comes in. If you had a restaurant in relation to the decision of the lower court, and it had a separate takeaway branch, there was still no cover, because you couldn't show there was no complete inability to trade or conduct your business. So if you had a restaurant with a separate takeaway and you started selling takeaway to make some money, keep your business afloat, you wouldn't actually get any cover, because the test was prevention of access is a complete inability to access the premises. The Supreme Court overturned this, saying actually that is not a reasonable construction of this clause. Then there must be complete closure of the business, of course, but not of the whole business, and only a discrete part of the business being closed would provide VI cover. So restaurants are a good example. The government has allowed takeaways to stay open. You can still obtain cover under prevention of access clause, even if the restaurant is open to an extent, and technically there is no complete shutdown or complete inability to access the premises, because you can look at the discrete element that is closed down, which is generally the restaurant. Jonathan, am I okay in time? Should I just whiz through the other points?
Yes, but if we can do it quite quickly, please. We've still got 2 more things that we need to cover today.
How long have we got to go?
We've got 20 minutes until the end of this is finished. But we'll
okay, I think what I'll do is I'll if we have time, I'll come to these later.
Okay.
I think they are important, but I'll come to them later or in questions. But I just wanted to make clear as to the fact that the Supreme Court has broadened the cover available to policyholders in respect of these non-damage extensions under these 3 types of clauses.
Thanks, Kostas. We'll now pass across to Will and then on to Paul again to talk about Brexit. Thank you.
Thanks, Jonathan. I'm going to talk about the topic that everyone was talking about before COVID, which seems to take up the last 4 or 5 years. But I'm now going to talk about the way forward on Brexit. And the headline point here is really that the trade and cooperation agreement that was just agreed just before Christmas actually doesn't say very much about the way forward for financial services. I've put up on the slide that 40 pages of the 1200 actually relate to services, but of these 40 pages, only 3 or 4 are actually dedicated to financial services, and those are just generic provisions which are sort of generally applicable across financial services. There's nothing of substance really on insurance at all. What that means is that after 4 or 5 years of talking about Brexit and what the future relationship might look like, we aren't really a lot closer to knowing what that might look like. This agreement is what we'd refer to as lawyers as an agreement to agree, and the parties are going to spend the next couple of months and possibly longer talking about what that future relationship might look like. Some things that we do know are that the UK and the EU have agreed that service suppliers from each other's territory will be treated no less favourably than suppliers from their own territory. Now, this doesn't actually mean that those suppliers must be treated the same. They can treat them differently as long as that treatment doesn't mean that they're treated less favourably. Another point that's been agreed is that each party, by that I mean the UK and the EU, each party is free to adopt measures for prudential reasons. And this means that we could see a divergence on prudential requirements in the respective jurisdictions. So, for example, over here, we could see an amended form of Solvency II in the UK, or potentially some replacement regulations. And this potentially has an impact on equivalence, which Paul is going to talk about shortly. Another point that's been agreed in principle, and this is more a question for or more a point for our employment team here at HFW, but the TCA contains protections for business travellers. In short, this means that business travel is permitted without any need for a work permit or a visa, which is good news for people from the UK visiting offices in the EU and vice versa. So hopefully business travel won't be interrupted. Finally, one important point which Paul touched on earlier is that the parties have agreed that internationally agreed standards should be adopted by both sides. This doesn't really come as a surprise because we wouldn't expect a divergence on things like money laundering, tax evasion, or as Paul mentioned, on climate change. However, DAC 6 is a good example of an area where, although both regimes are being adopted, we've already seen a slight divergence where the UK announced earlier this year that it was not going to enact certain parts of DAC 6. DAC 6 could take up a whole hour on its own, so I'm not going to go any further there. One measure that I want to touch on briefly, which suggests a desire for a relatively close relationship between the UK and the EU, but which may present problems in practice, is that each side has to permit suppliers from the other to provide new financial services that it would permit in its own territory. So in other words, if a UK financial services company comes up with a new product, the EU has to permit that. This is subject to one important caveat, which is the point that I think will cause the problem in practice, which is that you don't have to permit the supply of the product if it will require changes to existing laws or new laws to be introduced. And straight away, you can see that one side that doesn't like the look of a new product will prevent it being distributed on the basis that it needs a relatively minor change to the existing laws. So let's see how that works out in practice. At the bottom of this, I was just going to say briefly, the joint declaration at the bottom of the slide is the final step on this slide. It's again an agreement to agree. It's saying that a memorandum of understanding is going to be agreed in March. And again, we may see a bit more detail, but actually may be waiting for more detail. One topic that it might cover or address is a potential replacement for passporting. And that's a good place for me to hand over to Paul.
Thanks, Will. Paul. Sorry, I think you might be muted there.
Apologies, schoolboy error. I forgot to click the unmute button. Yes, thank you, Will. I think the unresolved issues are significant, if I can put it in simple terms. The history of negotiating trade agreements is not smooth. I think the fastest ever example of a trade agreement was something around about 4 to 6 months between the US and a Middle Eastern country, and that solely dealt with the export of a certain premium brand of cheese. Otherwise, the general form is that these kind of negotiations tend to either fall into two buckets of being negotiated over many months, if not years, or they fall into the latter category of a continuing round of negotiations, such as has happened between the EU and Switzerland. So it's highly unlikely, in my view, that any negotiations on equivalence will actually be wrapped into a single equivalence agreement. What is far more likely to happen is that the nearly 40 areas, or 42, I think, I've seen one count, that need to be addressed are highly likely to be dealt with on a series of bilateral arrangements. Some of the principles behind that may be applicable across other areas. So there may be some economy of scale, so to speak, in the negotiations. But nevertheless, there will be certain issues that will be difficult to resolve through equivalence. And one of those are things like, for example, retail banking, insurance distribution, because in the underpinning directives, there is no provision for equivalence. So that would have to be negotiated separately as an additional treaty provision. There is also this question of the long-term relationship. You know, we must understand that the EU was born out of a political desire to avoid future war and mass casualties. That therefore the economic driver is important, but it's not by any means the critical factor. As a result of this, the EU is under absolutely no illusions that if it gives the UK a sweetheart deal, it can expect other countries to come knocking on the door and saying, well, I'd like one of those too, please. We'll leave the EU and have a UK style agreement. And that's not going to happen. So under those circumstances, I think we have to be mindful that there will come a point where the UK is expected to sort of accept the consequences of having voted to leave. So I'm sure there will be areas where trade will be smoothed and facilitated compared to where we are right now, or certainly clarified with that intention. But I don't see any possibility of there being a direct replacement for the passporting regime or the single financial services market access that we had previously. This is part really of the longer term sort of relationship framework between the UK and the EU, but I'm very minded, for example, of the report of a statement by Michel Barnier, literally just a week or so ago, who made it very clear that the EU Commission and the European supervisory authorities, the regulators, will be keeping a very close eye on market practices and particularly looking to identify and close down any suspected loopholes in terms of conduct of business that are used by UK firms to try and get around the current framework. So I think that there's a veiled warning there that this problem is not going to be ignored, and there will be no easy or quick fixes. You know, it will have to be negotiated, and it's a political decision at the end of the day. I think also, therefore, we need to accept that there will be no single sort of point of reference for equivalence. This will be a question that where equivalence is agreed, it will be on a sector by sector, and even within the sector, sometimes on a specific issue. In the insurance sector, the obvious ones that spring to mind are, for example, under Solvency II. There are three potential areas for equivalence, none of them easy or straightforward. And whether and if equivalence is granted, that will really only affect some of the prudential areas of the insurance sector and reinsurance. You know, it won't be of general or mass application to the insurance sector in terms of marketing and distribution and sales of policies. I think also the US attitude, as I referred to before, will come into play. You may remember Barack Obama a number of years ago saying that the UK would not be at the front of the queue in terms of negotiating a preferential trade deal with the US. I don't think, given that Biden was his vice president at the time, I don't think we need expect any significant change in attitude from the Biden presidency. The US is unlikely to want to rock the boat with a bloc of 27, the largest trading bloc in Europe, for the sake of the so-called special relationship with the UK. I'm not suggesting that the US would want to ditch friendly relationships with the UK, far from it. But what I am saying is that I don't think it will prefer the UK over the EU. I think there will be a fairly even-handed approach with an encouragement, strong encouragement actually, from Washington to the UK not to deviate too far from the EU. It's much easier for the US to have a fairly common European framework to deal with in terms of trade than it is to have significant divergence in the UK. And that brings me to the question then of whether the UK is a major financial centre. I will say I don't see ever a situation where the UK would not remain a major financial centre, but I think the evidence is beginning to crystallise that the UK's significant preeminence in Europe as a financial centre is beginning to be eroded already. We've seen the relocation of a large part of the Lloyd's business to Brussels. We've seen the emergence now of Amsterdam as by volume at least, a more important fulfillment centre for securities and derivatives trades than London. That has happened literally within the last 6 weeks or so. So the volumes have increased. We're seeing increasingly more aggressive stances and steps from the Commission and from Frankfurt and Brussels by both, particularly from the European Central Bank and EBA, but also from ESMA, to look to relocate over time clearing and settlement infrastructure for the derivatives, OTC, EMEA sort of market back to continental Europe, certainly for the euro denominated trades. And I think that trend will continue. It's also worth noting that the current equivalence regime granted for those sort of market infrastructure areas respectively are time sensitive. So we have clearing and settlement and derivatives basically being on a window of equivalence only up to 2021 and 2022. So from that perspective, that there is some pressure for clearers and settlers to basically get their game addressed, and no doubt that part of addressing that issue will be on a contingency basis to be able to relocate some of that business within continental Europe rather than allow it to wither in London. I think also what we will then see is, and this has been touched upon already, this question of future innovation. Part of the UK appeal, if I can put it that way, as a financial centre is the ability to innovate, but also to operate within Europe. It may well be the case that some of that ability to innovate is then effectively deflated to some degree by the fact that innovation in the UK is one thing, but being able to market that more widely across continental Europe may still prove a challenge. So these are questions that I think we will have to address, and we will have to watch developments closely. But I don't think we're going to get any quick fix on this. I think it will emerge gradually, and I think it will emerge on a sector by sector basis and an issue by issue basis, as opposed to one sort of catch-all agreement.
Thanks, Paul.
You're welcome.
When I pass across to Will, who can very briefly cover, if possible, the SMCR review, because I know we've got a couple of questions that have come in.
Thanks, Jonathan. Yeah, I'll be brief on this then. So after 4 years since the SMCR was introduced, the PRA undertook a review to see what effect it's had. I've put on the slide some of the more interesting statistics, and if we were in a conference room, I would have really liked everyone to do a show of hands so that we could see whether we were representative of this survey or indeed vice versa. What you can see, though, is a picture of strong support for the SMCR and the changes that it's introduced. I'm not going to dwell on any of these statistics apart from the one about whether the regime is proportionate. And it's a shame that the PRA's paper doesn't contain a bit more detail about why people felt that it was or wasn't proportionate. It feels like there's an interesting story to be told here, and perhaps people's responses or the Q&As might bring this to light. The report also identified 9 areas for follow-up action. There were 3 main ones that I wanted to talk about today, and I've put those up on the slide. But in the interest of time, I won't go through them in detail. In each case, the PRA has said that it will publish further statements or undertake further work in these areas. So we should expect over the next year or so to see policy statements or further surveys on the 9 areas marked for follow-up. If you do feel inclined to read this evaluation and respond to it, then you'll have to be quick. As it says at the bottom, the deadline for responding is tomorrow. And really, it's a case of watching and waiting to see what comes out of it. So that's a whistle-stop tour there, and back to you, Jonathan.
Thanks, Will. This now concludes the formal part of the presentation. We've had a couple of questions come in. Before we go into them, what I'm going to do is actually post my email address into the chat function of this webinar here, because we have got a couple of free giveaways we can to give away here. We have a list of delayed FCA initiatives which we can send out to you. If you would like it, please can you email me and request it, as well as a COVID return to work plan, which you can adapt for your firm. So if you want either of those, please can you email me and request them. As well, if you could also let me know if you'd like to be included in any further events that we're planning, to let me know. We can put your name on that list. To all the panelists, the first question that came in, I'm interested to understand the implications of not having a COVID exclusion on our PI insurance. Please, can you confirm the stance taken by the FCA and BIBA in this respect?
Sorry, I think that's for me, Jonathan. I think the way to answer this is just to say that as far as lots of policyholders are concerned, even though there are no specific exclusions in their policies, they argue that there should be cover, even in the absence of non-damage extensions. And I think that arises from a misunderstanding of the term all risks insurance. Now, the FCA is always proceeding on the basis that damage-based policies, as I said earlier, do not respond. I mean, they haven't actually confirmed it formally, but that's been their general position. So I think the position is probably that a standard damage-based policy will not respond whether or not there is an exclusion. And there are also issues in relation to non-damage exclusions. For example, even if you have a notifiable disease clause and an exclusion, the exclusion may not apply. And that's in relation to one policy, RSA 3, and depends on the wording. So in a very long-winded way, I think I've just said that it can be argued, even if you don't have an exclusion, that the policyholders are arguing that there may be cover, notwithstanding you don't have an exclusion. So I think it all depends on specific wordings, of course, and I would say that. But, you know, this is part of what's happening in the market at the moment. Brokers and insurers are putting exclusions together. They have already put exclusions together in relation to further events of COVID. But again, you know, it's a tricky issue because the court has made it so clear that they're bending over backwards to ensure that policyholders will get cover. So you've got to try and exclude disease, exclude the effect of this particular way of construing causation, the way in which you look at trends clauses, the way in which you look at causation generally. So I think you have to look carefully at exclusion clauses, because even if you think your cover is not including COVID, policyholders are still arguing it does. And again, the other point is that this decision doesn't cover all policy wordings. It just covers the policy wordings that were in play during the Supreme Court, the FCA test case.
Thanks, Kostas. Another one, I think, for you here. Our business interruption policy lists the diseases we are covered for. Does this mean we cannot claim for COVID-19 business interruption despite suffering BI losses?
Sorry, I didn't grasp that question. It may be one that I answer later. It's probably better.
Yeah, of course. We can get the details from the individual who sent that in, and we can get
same for the last one. I'm happy to answer offline.
That's great. I know we're overrunning by a couple of minutes. We have one more question coming in, if the panelists are okay to stay and discuss this last one. When talking about the trade and cooperation agreement, you mentioned the UK and EU are going to work on a framework for doing business across the UK-EU border. Does this mean that after all the twists and turns, we might see a return to passporting?
Sounds like that's one for me, so I'll take that one. I would be very surprised if we did see a return to passporting after all of this. I suspect that the more likely position is something unique that isn't based on passporting or equivalence. At this stage, we just don't know, but I'd be surprised after the posturing if we did see a return to passporting.
Thanks, Will. that sort of concludes the questions now. I'd like to thank all the attendees for joining us on today's webinar, as well as our panelists, Costas, Will, and Paul. Thank you very much for your time today. I'd also like to thank our partners at J7 Communications for helping us promote this event. They are specialist financial services, PR and communications boutique. This webinar has been recorded and will be put online, so you can watch and share it afterwards as well. So please feel free to follow HFW and Complyport on LinkedIn to see when this becomes available. As a reminder, to get hold of the freebies I've mentioned, please can you email me, and my email address is shared in the chat here, and I can respond with all the information. If you have any further questions after this webinar that you'd like to discuss with any of the panelists, again, please email them to me and I can distribute them accordingly. From everyone on our side, thank you very much for joining and have a very good day.